Good afternoon, everyone. Thank you and welcome to today's program on Secure 2.0, Deja Vu all over again. I'm Alan Spear, president of our New York chapter of the Worldwide Employee Benefits Network. Thank you very much for being with us here today. For those of you that are attending our presentation for the first time, let me briefly tell you about our organization. The Worldwide Employee Benefits Network is a national organization committed to providing employee benefit professionals educational and relationship building opportunities. Our success comes from attendees like yourselves to our local chapter programming and networking events. I'm happy to say that 2023 is WEB's 40th year providing programming for benefit professionals. WEB was formed in 1983 in response to the adoption of ERISA. Our members represent more than 25 professions and 30 areas of expertise in retirement and the benefits industry, including plan administrators, plan fiduciaries, investment managers, communication experts, and benefit managers. Industry consultants to the C-suite and service providers such as accountants, attorneys, brokers, and consultants also make up our community. Our plan sponsor members come from many industries and range from small startups to Fortune 500s. We'd like to invite you and your colleagues to get engaged with our web organization. Please respond to the email which provided you a link to today's meeting if you'd like to discuss membership and sponsorship opportunities. Speaking of sponsors, I'd like to thank our partner sponsors: Aetna Medical Solutions, American Century Investments, Fidelity Investments, Invesco, John Hancock, MFS, Nationwide, New York Life Investments, Prudential, Transamerica, Voya, and Practical Law. Thanks also to our national sponsor, Benefits Express, and everyone at Web National and our local steering committee who make these programs possible. I'd like to remind everyone that today's meeting will be recorded and available to attendees on request. If you're using your phone, please put your phones on mute so we don't hear background noise during the program. You can use the Q&A box at the bottom of your screen to type in questions, which I will ask Jane, our moderator, at the end of the meeting and at the start of the Q&A towards the end of the meeting. If any attendees are requesting New York CLE for this program, you must make note of any program codes mentioned during the program and insert them on the affirmation form, which was included in your email invitation to the event. Please then return the form to our CLE coordinator, Derek Nelson, using the email address listed on the form. And now I'd like to introduce our distinguished speakers. Jane Lee, who will be our moderator today, is a principal and retirement compliance leader in Bucks Compliance Consulting Practice and is based in the New York City office. Jane has over 30 years experience in benefit matters, having previously served as both outside and in-house counsel. She is experienced in the design, compliance, and administration of benefit programs with a focus on qualified and non-qualified retirement plans, and has assisted organizations in addressing design, operational, governance, and plan merger issues. She also has a human resources and employment law background. Pat Trunzo is a director in Bucks Compliance Consulting Practice and is based in the Pittsburgh office. With 25 years of employee benefits experience, Pat helps build sponsors, administrators, and fiduciaries address the laws that impact the design and operation of their retirement and health and welfare plans. Prior to joining Buck in 2021, Pat worked for many years in the employee benefits practice of a large multinational law firm. He also worked in the human capital practice of a multinational consulting company assisting employers with the design and operation of their employee benefit programs. Fred Farkash is a director in Bucks Compliance Consulting Practice and is based in the New York office. He has worked in the employee benefits field for over 30 years. He started his career providing administrative services to defined contribution plans, later switching to a compliance support role in 2000, and then switched to compliance consulting in 2005. Fred's responsibilities include consulting with clients concerning both retirement and health and welfare plans. Fred's special areas of expertise include development of administrative processes and procedures, IRS compliance testing, minimum distribution rules, and the correction of operational errors. Jane, I'll turn over the conversation to you now as moderator.
Thanks, Alan, and thanks to all of you for joining us today. Seems like we were just here. As Yogi Berra once said, it's deja vu all over again, and the Secure Act is fast becoming our Bill Murray Groundhog's Day. The timing of this session also seems appropriate with pitchers and catchers reporting for spring training this week. So as you no doubt know, the bipartisan retirement security package known as Secure 2.0 that was signed into law on December 29th contains over 90 provisions, more than 70 of which were affecting retirement plans. These provisions cover a wide expanse, in some cases clarifying or modifying some Secure 1.0 provisions, but mostly focusing on bolstering retirement savings by making savings plans more attractive to employees and simplifying administration for employers. We're not going to cover all of 2.0 today, but we are going to highlight portions that might be of particular interest to plan sponsors and administrators. The next few slides are mostly just for your reference. This is the legislative history of 2.0. This is the table of contents to the legislation. This slide covers a timeline of select provisions from 2.0, but note that the timeline provides a snapshot of some of the main provisions just to illustrate the broad scope of the legislation and the time span over the effective dates. I'll note that we're seeing a great deal of interest from clients in treating 2.0 holistically with plan redesign to promote participation in their plans and also the financial wellness and retirement readiness of their employees. When viewing the timeline and maybe designing a plan to incorporate some or all of these new features, remember to incorporate union considerations, such as the need to obtain side letters or even the renegotiation of labor agreements as needed into the timing of your plan changes. Also keep in mind that the implementation issues. DC plans that are self-administered will need to incorporate any changes into their record keeping and payroll systems, and as you all know, that takes time. Outsourced record keepers will have the same implementation issues, and if your plan is an IRS pre-approved plan, you'll have to wait for 2.0 options that are offered by the provider under their amended adoption agreement. So this is the agenda for today. I'll just note that the DC plan provisions we're covering today apply to 401k, 403b, and 457bs, with some exceptions noted. With that, I'm going to turn this over to Fred Farkash.
Hello, everyone. Yeah, I'm going to get started talking about the changes to the required minimum distributions. For the most part, these apply to both DB and DC plans, and also they affect things like IRAs, but we're mostly going to focus on DB and DC plans. So in the way of background, under the RMD rules, distributions must commence no later than April 1 after the end of the calendar year when the applicable age is attained. And here up on the screen here, we've described the applicable age after the Secure Act 2.0 was issued. So you could use that for your reference. So also to be noted is that if the employee is not a 5% owner, they could commence later if, in that case, their required beginning date would be April 1 after the end of the calendar year when the employee retired. For surviving spouses, they can commence life expectancy distributions no later than the end of the year in which the employee would have attained the applicable age without the delay to April 1 after the end of that year. Now, Secure 1.0 raised the applicable age from 70.5 to 72 for those born after June 30th, 1949. And Secure 2.0 now raises it to 73 for those born after 1950 and before 1960, and then raises it again to age 75 for those born after 1958. So as you could see, there's some overlap in the rules for people who were born in 1959. So we expect that drafting error will be corrected via some type of technical corrections bill, or perhaps there's some speculation whether IRS could do that themselves. It seems that plans will need to be amended for this, and the amendment would need to reflect plan operations since Secure 1.0 went into effect. IRS issued proposed regulations in 2022 reflecting Secure 1.0, and it seems that it would be required as a formality even if the plan is keeping the old date for forcing actual distribution commencement, because the technical required beginning date still affects things like rollover eligibility for lump sums that contain an RMD payment. As has been the case since 1996, when the rules were changed to allow non-5% owners to delay their benefits until after actual retirement, plans could still require in-service commencement, but once they do so, they generally can't take it back after that, because there would be the anti-cutback rule unless the IRS offers relief. And IRS hasn't come out with any guidance providing that relief, but the Secure 1.0 and 2.0 provide broad anti-cutback relief in general, but they haven't clarified yet what the scope of that is. For DB plans, actual increases are still required to start April 1 after the year the employee attains 70.5, and that applies for every plan except for governmental or church plans. And of course, it doesn't apply for 5% owners who are required to start when April 1 after they hit their applicable age. As before, you have to provide the actual increase even if the benefits are suspended because the employee continues to work more than 40 hours or 8 days in a month. And the next item we have here is there's a reduction in the excise tax on late RMD payments from 50% to 25%. In practice, IRS had been waiving the tax routinely if the employee came forward and disclosed it after the fact and provided reasonable cause. It's not clear whether the IRS will be so willing to waive the penalty now that it's been reduced a bit. And another important change is that the penalty tax is reduced to 10% if they receive the distributions and pay the 10% excise tax within 2 years after the missed RMD. So one thing you want to do there is you want to let people know if you have a missed RMD situation, you want to let them know that they could apply for a waiver and the amounts of the tax being reduced. You probably would also need to let them know that even if you're requesting a waiver of the tax on a voluntary compliance program filing or voluntary correction program filing. And then another interesting change is the ability for a surviving spouse to elect to treat their benefit or account as if they were the participant. So this has been around for a long time for IRAs, and it allows a younger spouse to wait until after April 1 of the year in which they themselves attain the applicable age, as opposed to having to start by the end of the year when the deceased employee would have attained the applicable age. So that means also that if they were to elect that, it would mean the life expectancy factors used to determine an RMD in a DC plan or under DB plan lump sum, they could now use a uniform lifetime table factors, which are generally more favorable and have the effect of lowering the amount of the RMD. So for IRAs, there's sort of a default rule that says if you don't take your RMD in time, you're deemed to have elected to treat the RMD as your own account. So we don't know if the IRS is going to come out with a similar rule for employer-sponsored plans, but and it's not clear if plans will be required to offer the election. I think they don't have to from the way that the legislation was drafted. But if they do offer the spousal election, they'll need to amend the plan to offer it. And they'll also need to update their record keeping systems to, for example, take the elections and all that. Okay, now moving on to the next section. There were changes to the QLAC rules. The QLACs are a special contract where a participant in a DC plan or an IRA buys a deferred annuity contract, and payments under those contracts commence at a point in the future, no later than the end of the month, the beginning of the month after the participant attains age 85. And so when they do that, they basically get to exclude the QLAC from their RMD requirements. So you don't have to start taking any distributions till age 85. Now, before the Secure Act, the maximum amount you could buy a QLAC for was 25% or 145,000. And starting this year with Secure 2.0, it goes up to 200,000. The IRS has also clarified, or actually Secure 2.0 clarified that joint survivor benefits under a QLAC can continue to a former spouse after the divorce, but they have to say in the quadro or divorce decree how that would be required. These have been sort of slow to take off in employer-sponsored plans. They require a certain level of complexity administration. Okay, and then for the next tile here on the slide, the life annuities. Generally, under the RMD rules, the annuities are not allowed to increase unless they meet certain requirements. And the DC rules under the current regs have most of these provisions in them already, but this essentially just codifies them. They could have guaranteed annual increase up to 5%, and they could take a lump sum that includes a commutation feature or a refund feature, and they could increase due to policy dividends. So these may make the DC plan a little bit more attractive, but plans that offer annuities have to provide for spousal consent if the annuity is in a normal form. So that's still around. That's probably going to remain a barrier. Now, there's also a new rule under special needs trusts. That's a special trust set up for a chronically ill or disabled beneficiary. They were an exception under the Secure Act that generally restricts distributions over the lifetime to certain types of beneficiaries called eligible designated beneficiaries, and requires everyone else to take their entire benefit within 10 years. Generally, the idea behind these trusts is to avoid a person who's eligible for Medicaid or Social Security income from losing eligibility because they would get access to the entire retirement plan benefit all at once, as opposed to receiving a small amount every year. Under Secure 1.0, provision was added for certain multi-beneficiary trusts that where each beneficiary had a separate subtrust set up for them, and it was sort of a complicated design. But if I think there was possibly an error in drafting the legislation, because it said if there was any beneficiary that was not a person, that the entire trust, including all the subtrusts, would have to meet the 10-year rule, and this sort of fixes that. Next slide, please. So, and then there's also, this is another welcome change. The change for designated Roth accounts in 401k, 43B, and for governmental 457B plans. For plans that don't enforce or force employees out when they start to take RMDs, it eliminates the need to roll over the account to a Roth IRA before the start of the first distribution calendar year, to avoid having to take RMDs during the lifetime of the employee, which is, I guess, a very easy loophole for participants to take advantage of, as long as they were in the know about it. This rule will probably be difficult to deal with for plans that allow in-plan Roth conversions, as it's not clear if they will now have to issue an RMD on the balance being converted at the time the conversion takes place. But we think IRS would probably issue some guidance about how that would work for plans offering in-plan Roth conversions. Not all plans that have Roth offer that. Then there's also a rule changing the penalty, or quote unquote penalty, for partial annuitizations. And the IRS regulations previously did not allow distributions from an annuity contract to be taken into account in the year of annuitization, like they do for when the full account is used to purchase an annuity contract. So now you're going to be allowed to take into account the annuity distributions, even if just part of the account balance is used to buy an annuity. This is an optional provision for plan sponsors to add, and sponsors who add it will be required to take an election from the participant each year, and will need to obtain and store the information from the annuity provider, the amounts of the distributions, if the plan itself is not paying the annuity. It's not clear whether a plan could assume the employee's survival until the end of the year for determining the amount that will be paid from the annuity, or if they would need to get some sort of information feed of actual distributions made every time a distribution is issued from the annuity provider. If plans are allowed to assume the same monthly payment will be issued for the rest of the year, things could get tricky in the year of death. If, let's say, the annuity payments stop and you were assuming they were going to continue, this type of provision could be tricky to administer. So sponsors might want to wait for IRS regulations and see if their record keepers are up to the job before they decide to offer it. Okay, and then these next couple of changes were out of the RMD section. Phew. Okay, so for the additional changes to DB and DC plans, the first one is the small benefit cash out limit is going up from $5,000 to $7,000. The limit's been at $5,000 for about 25 years, so this is a welcome change, and plans are not required to provide a lump sum cash out provision, but those that do will more than likely want to take advantage of this. This will also help DB plans reduce PBGC premiums for participants with benefits between $5,000 and $7,000, especially for plans who pay the variable rate premium currently, where you could pay as much as $748 a year for a person if you were subject to the full variable rate premium cap, which is $652 a year, which brings the annual cost of carrying those participants up about 10% of the value of the benefit. So it's quite steep. The law doesn't change the threshold for mandatory rollovers, which remains at $1,000 for participants not making a affirmative rollover election and who get involuntarily cashed out before normal retirement age. Plans that drop their involuntary cash out to $1,000 to avoid dealing with mandatory rollovers will not be helped by the change. Adopting the change may require a plan amendment, and you may want to check your agreements with your automatic IRA providers as well. And then the last change here is that plans can now adopt amendments to increase benefits or contributions after the end of the year in which they become effective now up until the due date for the employer's tax return. Previously, their ability to do so was limited to, for example, if coverage or non-discrimination tests were failed and you needed to provide additional benefits to non-highly compensated employees. But now plan sponsors could do this even if the plan didn't fail testing, and even if they want to benefit HCEs more than non-highly compensated. Okay, that's it for my section. I think turn it over to Pat Tronzo for the rest.
Thanks, Fred. I'll be talking about defined contribution plan related changes under Secure 2.0. But before I get into some of the details, from Secure 2.0. I did want to talk a little bit about some drivers of DC plan success. Plan sponsors should really think about these drivers whenever they are trying to make a determination as to how their plan is operating, what's the success of the plan, and what steps should be taken in order to improve their DC plans. And one of the main areas relates to participation rates. Are employees participating in a plan at a sufficient rate? And ways to increase participation rates include things like auto-enrollment and re-enrollment. Company match is also useful to increase the participation rate because employees will see that there's employer money that's available that could be used, that could be accessed, so maybe they'll contribute to the plan. The savings rate is also important, and it's a key driver for the plan success. Are participants saving enough? Auto enrollment and auto escalation are a couple things that help to increase the savings rate. Re-enrollment in the plan, again, company match, that helps to increase the savings that the employee has, of course. And then there's the investment strategy. Plans should have a good sense for their investment strategy and how it's benefiting their employees. What's the qualified default investment alternative? Is it appropriate for their participation group? What's the investment menu, and so on. Now, as this slide indicates, these are all drivers to DC plan success, and what Congress recognized was the fact that these points or these items are important for a good retirement program, and they implemented changes that are intended in good part to increase participation, to increase the savings rate, and also some items relating to investments. So I'll turn now to some specifics under Secure 2.0. You're probably aware of the part-time employee requirement under Secure 1.0, the original Secure Act. Under that rule, defined contribution plans had to permit participants, I should say, long-term part-time employees to defer into the plan if they have worked at least 3 years where they had 500 hours of service or more, and they've reached age 21. So that was a requirement that was instituted under Secure 1.0. Secure 2.0 makes a change to that requirement. And so rather than 3 years, it's now going to be 2 years. So long-term part-time employees who have 2 consecutive 12-month periods with 500 or more hours of service and who've reached age 21 would have to be permitted to defer into the plan. Employees with 500 hours in 2023 and 2024 then would be eligible to participate in 2025 under Secure 2.0. The vesting rule is the same as service. 500 hours in the 12-month period equals 1 year of vesting. And in that rule, when you're looking at the vesting service and the eligibility service, you'd be looking at the January 1, 2023 date. When determining eligibility and vesting under Secure 1.0, that is, when you're trying to determine whether it's a 500-hour, whether the person's reached 500 hours in 3 consecutive years, Secure 2.0 clarified that pre-2021 service was not counted. That was kind of important because plan sponsors thought that vesting service prior to 2021 needed to be counted when it came to vesting service for long-term part-time employees. So that was an important change. In addition, this long-term part-time employee requirement will apply to 403B plans that are subject to ERISA, not just 401k plans. So as a couple considerations for this, it's important to coordinate with payroll and record keeping to monitor employee eligibility, making sure that they are eligible to participate in the plan if they've hit that 500 hours in 2 years rule. Keep in mind too that the long-term part-time employees with 3 years under Secure 1.0 would be eligible to begin deferring on January 1, 2024. And plans should also think about the fact that if they are making matching contributions to non-long-term part-time employees who defer into the plan, maybe they could go a little bit further and begin to match deferrals made by the part-time employees as well, as opposed to keeping them as a separate class within the plan. It's just a consideration to make when you think about the need to add in new long-term part-time employees. Should also point out, if you didn't understand or notice that previously, at the bottom of each of our slides, we have the date that the change becomes effective. So this change is effective in 2025. Next slide, please. Okay, expanding or promoting savings through auto enrollment and catch-up. That's one of the themes that we see in Secure 2.0, and it goes back to what I mentioned earlier. How do you improve or enhance the success of a DC plan? So auto enrollment is one of those areas under Secure 2.0. And under this requirement, most 403B and 401k plans that were established after the date of enactment, that is after December 29th, 2022, will be required to include an automatic enrollment and automatic escalation feature in their plan. The initial deferral rate would be between 3 and 10%, and the plan would have to automatically increase those deferrals up to by 1% each year until deferrals reach at least 10% and up to a maximum of 15%. Some exceptions exist. Small businesses with 10 or fewer employees, new employers in existence for less than 3 years, and church and governmental plans don't have to comply with the automatic enrollment requirement. As a consideration for new plans that are coming into existence after the date of enactment, while there's a 2025 effective date for this automatic enrollment rule, those plans might want to consider just implementing the automatic enrollment rule when they start up, as opposed to waiting until 2025, because that's just an additional complexity to think about later on after the plan has started. So it just might be easier to implement automatic enrollment and escalation when the plan starts up, as opposed to doing it a couple of years down the road. Higher contribution limits, or catch-up contribution limits apply under Secure 2.0. As you're probably aware, currently participants who are 50 or older can make additional catch-up contributions in addition to regular deferrals to the plan. And the additional catch-up contributions currently are $7,500. That's for 2023, and that number changes. Under Secure 2.0, individuals who have attained age 60 through 63 can make annual catch-up contributions at a higher level, the greater of $10,000 or 150% of the regular catch-up amount. So those limits will increase. And if we were to look at these numbers right now, let's say this higher catch-up limit were to apply now in 2023, the 150% prong of the test would apply. 150% of 7,500 is $11,250. So it's greater than the 10,000. So just keep in mind that as this is implemented, an amount greater can apply based on the 150% rule. Plan sponsors will want to think about payroll changes and tracking to make sure that they identify the folks who are eligible for this higher contribution amount. And again, keep in mind the fact that it's 60 to 63 through 63. The catch-up contributions, though, begin at 50. So it's an additional classification to track. But it shouldn't be a big deal to track, although it just adds a little bit more complexity to plans. Next slide, please. One item that has seen a lot of discussion on it before Secure 2.0 was passed and after relates to student loans. and the match, the employer match on student loan repayments. And in the subsequent slide, I'll go into a little more detail on the specifics. But this slide gives you an idea of the overall issue with student loan debt. Congress understood that there is an issue nationally with the level of student loan debt that folks have. And this provision is intended to help address that, at least to some extent, when it and also help retirement savings at the same time. What this slide indicates is for the class of 2020, 55% of graduates who received a bachelor's degree took out student loans, and the average was $28,400. So it's a significant amount of money that graduates are coming out of college with when it comes to student debt. And this graph in the right-hand corner is interesting because it gives you a sense for what the levels of debt are by employee age. And it's kind of surprising to me when I look at the far right column, which says that employees or individuals with student loan debt age 62 and higher have the highest level of student loans. There are over 50,000. What this indicates is we have a lot of employees who have taken out student loans for their children or for their spouses. And so when a plan sponsor is thinking about the possibility of implementing a match on student loan payments, those plans should think about their employees and not just go by the age of the employee. You know, it's 25 to age 49. There's also there are a lot of folks who have student loans at an older age. So it's important to really take a good look at all of the employees and determine whether or not this is something that makes sense for employees. Next slide, please. So some of the specifics relating to the student loan repayment match under Secure 2.0, it allows employers to make matching contributions on amounts paid for qualified student loan repayments under a DC plan or under a simple IRA. And a qualified student loan repayment, those repayments are payments made by an employee to repay a loan for qualified higher education expenses. The matching rate and the vesting schedule for the match on those student loan repayments would be the same as the match on regular deferrals that employees make. And when a plan sponsor implements this type of change, they would need to monitor the student loan repayments and aggregate those with elective deferrals in order to comply with Internal Revenue Code limits. And employees will need to certify annually that they are making these payments for student loans, and the employer can rely on the certification when they make the matching contribution. Next slide, please. Another common theme under Secure 2.0 relates to Roth contributions. There were a number of provisions of Secure 2.0 that related to Roth, and the impact of Roth obviously is something that the Congress thought about. One of the optional changes under Secure 2.0 relates to the optional treatment of employer contributions as Roth contributions. So plan sponsors can provide employees with the option of receiving a matching contribution or a non-elective profit sharing contribution on a Roth basis. Those contributions would have to be 100% vested, but it may be a nice and welcome option for some participants. So it makes sense for plans to think about whether this is something that is valuable to employees and whether they should implement it. If plans already have Roth contributions in them, employees are able to make Roth contributions, this might be an easier approach for those plans. Contributions will need to be included in participant income in the year contributed, but with this provision under Secure 2.0, and really all the provisions, we really need guidance from the IRS to tell us how it would be implemented, especially when it comes to reporting for income and employment tax purposes. So hopefully the IRS will come out with that guidance soon, because the effective date was December 29th, 2022. So employers are able to do that now. Mandated Roth treatment or catch-up contributions is a fairly significant change in the way plans are administered. Many plans offer catch-up contributions. We talked about catch-up contributions previously in terms of the limit, but Secure 2.0 also implements a change for high earners. High earners, who are folks who have wages in excess of $145,000 in the prior year, can make catch-up contributions only on a Roth basis. So plans will need to track these employees who are the high wage earners. And if they have catch-up contributions, they have to be made on a Roth basis. This is going to require some additional record-keeping changes and employee communication, so that they understand that their catch-up contributions will be made on a Roth basis. For those plans that don't already allow for Roth contributions, this will require a little bit more work if they in fact want to continue to permit catch-up contributions under their plan. Next slide, please. Okay. This slide summarizes a number of the distribution options available under Secure 2.0. The theme of Secure 2.0 when it comes to distributions is an intention to allow individuals to take money out of their 401k plan if they need it. And you'll see, and we'll go through each of these. They relate to emergencies and terminal illness and so on. Congress was looking at the idea that you have perhaps some lower paid employees who might be afraid to make contributions to a retirement plan because they're worried about meeting their day-to-day expenses, or if they have an emergency, do they have enough money to pay for it? Because they might be worried that money going into a DC plan just can't be taken back out. There are limits on distributions, of course. So people might not be as likely to make contributions to a DC plan if they're worried about being able to take the money back out. And so Secure 2.0 allows for additional provisions that plan sponsors can add to their plans so that participants can have access to their account balances. Should point out that with all of these options, except for the emergency savings account that I'll be talking about, all of the others allow for a distribution without the 10% tax penalty for early distributions applying. So it's not as expensive to take an early distribution under these provisions. And so I'll just start running through these. First item relates to the federal disaster distribution. So a participant under a plan that permits the federal disaster distribution can take up to $22,000 after a disaster, and they could repay that money within 3 years. And this provision also allows participants to take a loan of up to $100,000 in relation or following a federal disaster.
Excuse me, Patrick, if I could
Yes.
interrupt you just for a moment to give the first of our two CLE codes, and
Sure.
that would be Secure 2023. Secure 2023. Thank you very much.
So we have the first provision was a federal disaster distribution. The second one relates to terminal illnesses. A plan can allow for participants who have a terminal illness, and that's somebody that would be an illness that's been certified by a physician, and the illness or physical condition is reasonably result in death within 84 months, a participant can take a distribution in that case. The next item is the annual withdrawal that's permitted relating to qualified long-term care insurance or coverage for chronic illness or long-term care services. Under Secure 2.0, a plan can implement this opportunity, this payment opportunity, so that participants can pay up to $2,500 from their 401k plan or their other defined contribution plan for qualified long-term care insurance and related services. This is really, we've seen some real interest regarding this withdrawal option because, as you may be aware, a number of states have implemented some requirements relating to long-term care insurance. So this might be a way that employers can help their employees to make to be paid or to pay for long-term care insurance, especially in those states. And it seems like the number of states that are implementing these rules related to long-term care coverage are expanding. Emergency expense withdrawals of up to $1,000 are for certain emergencies are permitted under Secure 2.0. Only one withdrawal is permitted annually, and the participant can't take an additional withdrawal within 3 years after having received that first withdrawal, unless they've paid back the money that they've taken out. Emergency savings accounts and DC plans, this is available just for highly compensated employees. And this is a little different than the other options because it's a separate account. People call it a sidecar account, and it's money that goes into this account up to $2,500. And you can't go beyond the $2,500 in the account, but it allows for distributions when there's an emergency. And the plan sponsor can implement an auto enrollment feature if they wanted to, and then you'd have the match on the contributions that are made to the emergency savings account. And finally, we have domestic abuse withdrawals of up to the lesser of $10,000 or 50% of the vested account balance. And with these, the participant would self-certify that they are an abuse victim. And again, as with the other four of the other five, the 10% tax on early withdrawals are waived. And one final point relating to the distribution options that I'd like to make. These are optional. There's no requirement for an employer to institute one of these changes, but as with the other changes, it's a good idea to understand the employee base and to make the change if it makes sense for the employer and the employee base. And finally, we have a potpourri of a number of other Secure 2.0 changes. We obviously haven't covered all the changes that apply to DC plans, but these are just some additional ones that I'll just cover quickly. There was a change under Secure 2.0 relating to birth and adopted child withdrawals. Under Secure 1.0, plans are permitted to allow participants to take out money for birth or adoption expenses. Under Secure 2.0, the repayment period is limited to 3 years for these types of withdrawals. So if an employee wants to repay it, they have 3 years to do it going forward. 403B plans now are permitted to make hardship distributions to employees in the same way that 401k plans can make hardship distributions. And the rules are pretty much the same, but there were some changes, and the additional changes under Secure 2.0 relate to salary deferral withdrawals, QNECs, and QMAC accounts. Hardship distributions can be made on from those accounts, and it can also include earnings. So that's could be an important change for certain plans, and a loan is no longer required prior to taking a hardship distribution. Sponsors of DC plans can now offer de minimis financial incentives to encourage employees to participate in the plans, and it could be in the shape of let's say a low dollar gift card. Previously, the only real incentive that an employee could offer would be a matching contribution under the plan. Now they can do some additional smaller things. There's some rules relating to automatic portability providers. This relates to rollover monies and getting those monies into an employer-sponsored plan. And then there's the federally funded matching contribution, the Savers Match under Secure 2.0. The federal government will fund a matching contribution directly to a plan of the employee's choice. It's a matching contribution up to 50% of the employee's contribution, up to $2,000, and it phases out based on income. We don't think that this requirement would apply necessarily to all defined contribution plans. Instead, an employer plan would need to accept these federally funded matching dollars. If they don't accept it, then the employee presumably would have to have the money transferred to an IRA on their behalf. And I think that's it for me. At this point, I'm going to take it back over to Fred, who's going to talk about DB plans.
Okay, yeah, I'm going to pick it back up here. So, the first item here is the end of inflation indexing for the variable rate premiums for PBGC. This is an exciting change in that plan sponsors felt that this rate was skyrocketing in the last few years. It was originally just $9 per $1,000 of unfunded vested benefits in 2013, and since then has increased more than fivefold. Unfortunately, the per participant cap, which is currently $652, will still increase with inflation. So it's kind of a mixed bag there. When the per participant cap was first introduced, it was $400. So it's increased quite a bit also since 2013. This will not affect the flat rate premiums, which are currently $96 a head, and will continue to be indexed. Okay, and then for the next item here, retiree health benefits and pension plans. This pertains to what we call Section 420 transfers based on the Internal Revenue Code section that applies to these. Pension plans that were overfunded are allowed to transfer the excess assets to 401h retiree medical accounts or to buy life insurance. And this rule was set to expire at the end of 2025. So this extends that provision for another 7 years, which gives you enough time to plan and set these types of transfers up if funding improves sufficiently. Generally, the plan had to be very well funded, at least 125% funded to take advantage of these transfers. And the employer had to commit to not reducing the medical or life insurance cost for each participant covered for 5 years, starting with the year of the transfer. So, there had to be a commitment for more than just a short-term to fund these accounts. This doesn't make that any easier. However, they did add a new de minimis transfer rule. If you just transfer 1.75% of plan assets or less, if the plan is only 110% funded, this does not apply to collectively bargained transfers. One drawback there is that the cost maintenance period expands from 5 years to 7 years for those de minimis transfers. And then with regard to cash balance plans, this has to do with the backloading rules that looks at how steeply benefits accrue under the plan formula as the employee approaches normal retirement date. Now, there are 3 rules that can be used to meet this requirement: the fractional rule, the the 3% rule and the 133 1/3% rule. Most cash balance plans use the 133 1/3% rule. Previously, cash balance plans had to use the most recent interest crediting rate to project whether the plan complied with the backloading rules. And with the recent very low interest rate environment that we had, which I don't know, seems to be dissipating, plans that had steep pay credit increases and low interest crediting rates might have had trouble meeting the backloading rules. And some may have had to even redesign their plans to provide for either better pay credits at younger ages or to put a floor on the interest crediting rate to ensure that the backloading test would be passed. Now, with Secure 2.0, the plan's actuary can determine a reasonable projected interest crediting rate, such as, based on a long-term rate rather than the current interest crediting rate, subject to a 6% cap. So you might want to have the actuary take a look at the plan's formula to make sure there's no problem. And this could start applying, starting in 2023. So this provides relief for some of those plans. Okay, next slide, please. Okay, so there was a mortality table update change. This is kind of a very technical one that I don't know, it's probably not going to impact your daily lives very much, but I think that there were some complaints by plan sponsors.
I'm sorry, Fred, I skipped the slide.
Oh, you did?
Oh, no, I'm sorry.
Okay.
Sorry for interrupting.
Okay. The first, so this one, so plan sponsors were saying that it looked like the mortality improvement assumptions were a little bit too pessimistic, or I guess optimistic for people living longer, but pessimistic for having to fund for people living longer. So this 0.78% mortality improvement cap, requires that the IRS not take that mortality improvements greater than 0.78% at any age into account. And I think that was based on some Social Security projections that look at a broader population than what's typical for a people covered by an employer-sponsored pension plan. So I think the IRS is directed to look at Social Security's mortality improvement assumptions for any changes from the 0.78% cap. IRS uses a special unisex version of the funding standard mortality tables to determine the mortality table used for determining lump sums under plans. So it remains to be seen if the IRS will follow suit and incorporate the 0.78% cap for that purpose. So I guess that this is, again, this is something that the plan actuary should be assisting you with. Okay, and then for the annual funding notices, there were changes to the information that's required to be included in the annual funding notice. There are a few new data points to include, such as the rate of return on planned assets, which was never required to be disclosed before, as well as participant accounts in the prior 2 years. The actuary may need to disclose, or may need to work with plans investment managers possibly to determine the rate of return on assets, or unless, I'm not sure if they're going to issue a formula, or if this is just something actuaries are adept at anyway. But that plans are also going to be required to include a statement that the PBGC's actuarial determinations use actuarial assumptions that are generally show a lower funded percentage in determining the maximum amount that would be covered in the event that the plan sponsor couldn't pay for the plan. And So I think mostly this is going to be handled by your actuary. If your actuary is preparing the annual funding notices, they're going to be all over this. So I guess just to make sure that they're on top of it is probably what I would recommend for most plan sponsors. For the last item here, there's a requirement to provide lump sum window notices once final regulations are issued regarding this section of Secure 2.0. Now, in the last 10 years or so, more and more plans have been offering lump sum windows to eliminate some of the plan's liabilities, both to de-risk and reduce PBGC premiums. And some have complained about the short time frames participants were given to make such an important decision as to whether to take a lump sum and the limited information that was provided. Starting after the final regulations are issued, participants have to be provided with a window notice at least 90 days before the lump sum window starts, not just, let's say, 90 days before the actual payment is made. And in addition to some of the things they were already required to disclose under the like, for example, Section 417 regulations, they now must also be informed about the actuarial assumptions used to calculate a lump sum, whether it includes early retirement subsidies. They have to be given expanded relative value information comparing the lump sum not only to the value of the single life annuity, but also to the qualified joint and survivor annuity, and a statement that they may not be able to buy a commercial annuity with their lump sum that gives as good an annuity as they could get under the plan. Additional disclosures include they have loss of PBGC protection, protection from creditors, spousal protections, and also a general discussion about the financial and tax implications of taking a lump sum versus receiving an annuity. Reports to the PBGC and DOL have to be provided 30 days before the window opens, providing basically the same information as provided to participants, along with who's going to be eligible for the window and how long it is in terms of the window length. And also 90 days after the window closes, you have to tell the PBGC who took the lump sum from that group. So this will add to lead times for lump sum window projects, which are currently sometimes undertaken with pretty short lead times. So you probably want to plan with your administrative group and your actuaries to make sure that that these additional disclosures are complied with. Okay, that's it for me. I think Jane's going to take us through the next segment.
Okay, thank you, Fred. Fred, do you think with these lump sum window notice regulations pending that you might see some sponsors accelerating their plans to do windows now before all these restrictions come into play?
I think so, because it kind of makes sense that these additional costs, that mailing out additional notices may actually, raise the cost of the program, and I'm not sure if it would affect the take rates significantly. But I guess if you give someone an extra 10 pages to read before they make a decision, some people will just get annoyed and throw the whole thing in the garbage, I'm thinking. But that's another reason why you might want to do it before these window rules start out.
Right, and it seems like it'd be a little less cost to the sponsor in rolling out a window. Thanks, Fred.
Mhm.
So I'm just going to go through the some of the administrative simplification rules. As you know, 2.0 expanded EPCRS effective immediately to allow for the self-correction of inadvertent errors and planned loan errors. What constitutes an inadvertent error is a judgment call between sponsors and their counsel, and may or may not be clarified further when EPCRS is updated. But I think allowing the self-correction of planned loans is a welcome relief to many of us, employers and practitioners, of what we've long thought should be correctable without application to the IRS. Also, just a reminder to use the self-correction program. The plan needs to have established procedures promoting and facilitating the sound compliance and operation of the plan. EPCRS states that procedures can be formal or informal, but in the use of the plan document for that purpose is not sufficient. And remember, all corrections and the methodology used to correct should be consistent and documented in your plan records. 2.0 also provides more definition on how plan overpayments may be recovered. However, with this definition comes more restrictions, such as the 3-year cap on being able to recover an overpayment and a limitation on the recovery of overpayments through a reduction in future benefit payments. That would require a continued monitoring of those future payments. Also keep in mind that EPCRS provides correction principles and safe harbor correction methodologies, but those procedures also acknowledge that there may be more than one reasonable and appropriate correction of a failure. So it's really important to discuss the details and facts of a failure and the correction options with counsel as appropriate. EPCRS is making it easier for sponsors to self-correct failures, and we're seeing an upsurge in interest from plan sponsors for compliance reviews to address failures early and self-correct wherever possible. Sponsors may also want to have a limited scope compliance review done from time to time. For example, contribution reviews in a DC plan, or distribution and payment processes in a DB or a DC plan, in light of these limitations on the recovery of overpayments. This potpourri slide lists, a number of other administrative types of changes that Secure 2.0 is going to implement or has implemented. I'm just going to cover a few of them. You can use this as a checklist. And I'll just point out that some of these are the ones that are immediately effective. Section 312 allows for the self-certification of hardship withdrawals. And again, you may need to change your procedures a little bit if you want to accommodate that change. And if you have a pre-approved plan, you'll have to check with the administrators to see what their timetable is for that. Section 339 provides that tribal DROs can be domestic relations orders have parity with state domestic relations orders. And that's an issue that's given many of us pause from time to time, as we as you know, the Quadro rules specifically state did specifically state at present that they were subject to state DROs only. Section 320 relieves the burden and cost of providing ongoing participant notices to employees who receive those notices at the outset but don't elect to enroll in the plan. And they have certain requirements that need to be met in order to take advantage of that change. More potpourri items for you to consider. Section 102 increases the tax credit for pension plan startup costs for a small employer. A lot of incentives there in Secure 2.0 and 1.0 to encourage small employers to adopt plans. Section 345 is a clarification to a Secure 1.0 provision that allows certain unrelated employer plans to file a joint 5500. And Section 306 eliminates the first day of the month eligibility requirement for 457B plans, pretty much bringing those plans in line with 401ks and 403bs. So that's the end of our formal presentation. I think we're going to, just remember, it ain't over till it's over. And we expect that there'll be future guidance issued in the coming years, including the much anticipated missing participants lost and found. I think that's something we're all looking forward to. So now I'm going to turn it over to Alan for the Q&A portion of the presentation. Alan?
Jane, thank you very much. There were a couple of questions that came in through the chat and were answered, but the questionnaires may not have seen the answer. So I'm just going to read that quickly while folks still type in a few questions that are there. One question early on was, if a plan is established today, does it need to have auto enrollment? And Fred answered, yes, they do have to be auto enrolled by the start of the 2025 plan year, unless they meet an exception: new employer, less than 10 employees, church or government plans, etc. There was another question in the chat.
Alan, I'll just add to that, while it doesn't have to be added till 2025, what we're finding is that employers that are looking now to create new plans or perhaps spin off of a plan, from a plan to another plan, they're creating auto enrollment, auto escalation now. I mean, there really is no reason to delay, and why handle it in 2 stages when you might as well do it now. So there's a lot of interest in including those provisions, even though they're not due, you're not required to do it yet.
Thank you, Jane. And there was another question there. Can Section 115 withdrawals also be self-certified? Would a plan need to reflect this as an additional permissible withdrawal? Gross up, question mark. Do we need guidance as it is not effective until next year? And Fred did respond, yes, they can self-certify. I don't know if you'd like to expand on that.
I can jump in here. These are optional provisions. Any of these withdrawal options are, plans would need to provide for them. And in addition, there are the existing hardship rules that permit distributions upon a hardship, but generally plans follow the safe harbor requirements when it comes to a hardship distribution, and those permit distributions in just certain limited circumstances. These expand on those rules a little bit more, and so the plans would need to set forth the option to take a distribution in these cases, and then limit them as they feel appropriate. And then in addition to that, of course, we do need guidance to really spell out how these things would have to work.
I wanted to add to that. So I think the question was also about permissible withdrawals. I think where let's say under auto enrollment, you're allowed to, for example, do an unwind of the automatic contributions if it's if they request a withdrawal. They don't want to have the automatic contributions occur within, let's say 90 days or whatever. They could conceivably have an overlap, let's say if they were meeting the rules for the permissible withdrawals, then they may not even be subject to this, so they could take the money out under the permissible withdrawals first, perhaps, and then if any contributions went in there that were too old for the permissible withdrawals, they could do it under the permissible withdrawal, the emergency savings withdrawal here. I think that's what you were getting at. I'm not sure if that's exactly your question. And there was something about gross ups there. I guess it would depend on, I think since it's self-certification, would you have to calculate a gross up for someone who's self-certifying if they don't do that themselves? I don't know about that.
I think that
rely on whatever they ask for anyway.
Yeah, I would think that it could include a gross amount for income taxes, but we'd need to have some guidance in that regard. And if I can just mention one other thing, distribution options, these withdrawal or distribution options, however you'd like to term them, under Secure 2.0, a lot of employers are thinking about them. There are quite a few options that will become available over the coming years. And while it could be viewed as a very positive thing for employers and employees, one of the comments that we're getting from our clients is the idea that they don't want their 401k plan to serve as a checking account. And that's one of the issues that came up previously in prior years with hardship distributions for some employers. And so it's important when you think about implementing these withdrawal opportunities, it's the balancing act of, okay, what's important to employees right now, and really what's the purpose of the retirement plan. It's supposed to be a vehicle for retirement funding. And so employers really have to think through these options and implement the ones that they really think are appropriate for their employee base, but also think about adding in restrictions as they think appropriate, limiting the numbers of certain withdrawals, and factor in loans and what limits should be implemented on their loan provisions, their regular hardship distributions, and any other distribution options under the plan. It really needs to be viewed holistically when a design change is being thought about.
Patrick, I do have a related question, but first I want to give the second of our 2 CLE codes for today, and that's Secure Retirement 2.0. Secure Retirement 2.0. And a related question to what you were just speaking about regarding distributions is as follows. We already offer hardship withdrawals. Why offer terminal illness withdrawals as well?
I can
Jane.
take that. Yeah, sure. So while there's a safe harbor for hardship withdrawals to cover immediate medical expenses that are documented, the terminal illness withdrawal allows someone who is certified with the terminal illness to use that withdrawal for any purpose. So it's a lot broader. And while both types of withdrawals are not subject to the 10% tax penalty for early withdrawals, the terminal illness withdrawal can be repaid within 3 years. So the other thing to think about is that the terminal, when we talk about terminal illness withdrawals, we're not, the person's certified as possibly, dying within the 3-year period, but it's, it's a doctor's certification and not a real death sentence necessarily. So that's the reason why the rollover is good, and also even rollover in terms of estate planning might be a benefit to a participant.
And I think another point with the terminal illness withdrawal is that, it's conceivable that the participant could apply for the 10% penalty, even if the plan does not offer it as a terminal illness withdrawal. When they file their taxes, for example, they could apply for the waiver of the 10% penalty on the basis of having the terminal illness and attach a doctor's certification to their return. And also, there's hardships don't necessarily have a 10% penalty exception. I think the medical one is like the one that you mentioned, Jane, is one that does, but there are other reasons why you might not qualify for 10% penalty exception.
Fred, thank you. We do have a few more questions. One is just to clarify, does the 2,500 savings amount limit the amount that can be contributed under 402G?
Yeah, I could take that. Yeah, the answer is yes.
Okay. Another question is, can we get rid of catch-up contributions or just not allow for the new additional catch-up between ages 60 to 63?
I can take that. I think that you can get rid of catch-up contributions. That's an optional, not all plans permit them. It's not something that's required. And I do think that you can limit the catch-up contribution so that there's not an increase up to the 10,000 or 150%. I think that you can cap it for everybody.
Okay. There was another question earlier. How do you think the new plan definition will be applied in plan mergers and spinoffs?
I could take a shot at that one. I think that's an excellent question. I think that if the spinoff, in the spinoff of a plan, as opposed to just the spinoff of the employer, it appears that the effective date of the original plan would apply. So if the plan was established before December 29th, 2022, then you wouldn't have to provide for the auto enrollment. If instead we were talking about a spinoff of a plan sponsor from an existing company, setting up a new plan and then spinning off the plan after, which is something that often occurs when you have a new corporate entity spinning off of an old corporate entity or something, it appears the new plan would have to meet the auto enrollment requirement. For plan mergers, I think the effective date of the plan receiving the transfer would be determinative of whether you have to meet the automatic enrollment. So even if the effective date of the transferring or merging plan predated the date of enactment, I think the employees that are merging into the plan would have to meet auto enrollment. But it's a very good question, and I think we could use some guidance on that particular topic. It's kind of up to interpretation. They might come out with a rule that says if you accept the transfer of assets within a certain period after setting up a new plan like this, or in connection with a merger, you don't have to do it. But I think until IRS comes out with that, I would err on the side of implementing the automatic enrollment.
Thank you, Fred. An earlier question also was, can PEPs use the group of plan 5500 rules?
I believe the answer to that is no, because there's a separate set of rules for PEPs. And I think the group of plan 5500 rules are specifically designed for plans that are not PEPs. But I don't know of any such guidance that was issued that says exactly that, but that's my feeling.
Thank you for that. Another question, under EPCRS, can a plan still recoup overpayments of annuity payments by adjusting future benefits?
Yes. Or does someone else want to take it?
No, go ahead, Jay.
Yeah. Yes, you can do that, but there are restrictions, and the restriction is that the overpayment, when the increased deduction, the deduction for the overpayment reaches the amount of the overpayment, you have to stop the overpayment amount. It has to revert back to what the original payment was. And you cannot deduct fees or interest. It's just the straight amount of the overpayment.
Thank you, Jane. Another question is, for the proposed match on student loan repayments, does that also apply to loans that an employee takes out for spouse, child, grandchild, or another person?
I could take that. It seems that it would. When you look at the statute, it indicates that it's a payment being made by the employee, but it doesn't specify that it's only a loan taken out for the education of the employee. And then when you look at the rules, it really seems that it would be the employee or the employee's spouse or children or other dependents of the employee who could qualify under this. So it'd be repayments being made by the employee for loans that are taken out for spouse and dependents.
Thank you, Fred. Another question comes in. Who pays the excise tax on missed required minimum distributions?
Oh, that's the participant or beneficiary who should have received the required minimum distribution is responsible for the payment of the excise tax.
Pretty straightforward. Thank you. Another question, for DB plans, does Secure 2.0 change the flat rate premium account?
I think we covered that when we were going over that, but no, it doesn't change the indexing of that.
Okay. I think we have one more. For the emergency savings accounts, do contributions get invested according to the same elections that the participant has for their regular deferral contributions?
I can take that. No, they're not. The amounts in an emergency savings account need to be invested in an interest-bearing account or some other investment that's intended to preserve principal and provide a reasonable rate of interest. So something conservative and that maintains the principal.
Thank you. And actually, another question regarding emergency savings accounts. How will the annual ADP ACP testing be performed on contributions to these accounts? Will it even be required?
I'll take that one. So yeah, I think the employee contribution part, which would be, basically designated Roth contributions, would be included in the ADP test, and the employer matching on it would be included in the ACP, unless, it's possible this could be part of a plan that had, a safe harbor or something like that. But if it was set up that way, I guess, if it was not a safe harbor, then you would have to include those amounts for ADP and ACP testing. And since they're, you know, designed for non-highly compensated employees, I think it would help the tests and not hurt them to include them.
Okay. Thank you all. That's pretty much for the questions that we have at the moment. Jane and Patrick and Fred, we really appreciate the time you spent with us today, your thoughtful presentation, and certainly taking time to address questions from our web New York audience. Obviously, the new provisions of Secure 2.0 are very important to all of us who work with retirement plan sponsors and plan participants. We look forward to staying in touch with you and to your continued guidance. And I want to thank you again, as well as our national and local chapter sponsors, our members and guests who joined us today. And a special thank you to our event leader, Sarah Richards, and our terrific Web New York steering committee who helped put today's meeting together. Also, I'd like to remind you that we would like to have you engaged, you and your colleagues, in our New York Web organization. And we look forward to resuming live in-person meetings next month, March 23rd in Midtown, New York City, where we'll be joined by attorneys from Proskauer Rose, who will be leading us in a discussion on current litigation trends involving plan sponsors and participants in DC plans. I hope you'll all be able to join us as we come together for a community for the first time since early 2020. Please respond to the email which was provided to you earlier for the link for today's meeting to discuss membership, sponsorship opportunities, and also to propose topics you'd like to hear discussed in the second half of 2023. We appreciate you all joining us today and look forward to continuing our conversation in person next month. Thanks again and have a great afternoon.